A very happy Diwali to all our viewers. For the last 10 years, on the occasion of Diwali, we have here on NDTV Profit got you some of the best voices from the market. Diwali is a time for celebration. It's a time for learning and learning from the best. Words of wisdom with Raamdeo Agrawal. He's with me right now, Joint Managing Director at Motilal, Oswal. Sir, thank you very much. Great to have you with us here.
Yeah, let me first wish all your viewers a very, very happy Diwali and a prosperous New Year. And very, very happy investing experience.
It's been lovely speaking with you over the last 10 years on this occasion. And I mean, we always learn something new. Let me start this conversation by kind of contextualizing the situation at this point, which is clearly challenging. You know, be it the global macros, global deflation, the India corporate profit stagnating. We know the whole thing, right? So the market doesn't have too many tailwinds. It has got lots of headwinds. How are you doing? You're managing money. You're advising people. How difficult is it?
This is the best time, actually. Best time, the testing time for the competent managers. And those who can do it now, they can always do it. Because, as you said, it's a headwinded environment. And headwind, my sense is that headwind is now kind of slowing down, though the tailwind has not started. Indian markets, let me tell you, the size of tailwind is there on the long-term basis. What we are talking about is, let's talk about headwind and tailwind. On a 30-year basis, this market is 100x, ex-dividend. On a 25-year basis, this is 100x, cum dividend. Okay, so this is the ultimate bull market in the world, for whatever reason. Okay.
It already is.
It is. I mean, that's been the history of last 25 years, and I don't have any reason to believe the next 25 years will be less exciting. Probably it will be even multiple times more exciting. Okay. I don't say that index will be 100x in 20 years or 15 years. No. I think most probably it will take 30 years. But in those 30 years, the amount of money which will be made is going to be staggering. Because now the opportunities have become global. So that's the long-term thought process. Long-term, there's an ultimate tailwind on Indian markets. But short-term, because long-term is made of a lot of intermediate and short-terms. Right now, as we have seen, there is a challenge for 4-5 years. Index is stuck after 2007 bull run, which ended up at about 21,000 in Sensex. Is at about 27, 28,000, which is gone nowhere. In 7-8 years, if you are 20% up or 30% up, I don't think market as a whole has done much. Yeah. So it's a headwind environment. But there are companies which have won big, and there are companies which have lost big. That we'll discuss a little later. But money has been made even during this year, during this headwinded period. Once you are able to make money in this period, I mean, tailwind itself will take care of, portfolios when that good time starts.
As a money manager, as a fund manager, managing public money, is this, I mean, you're saying if you're able to do great during, say, for example, the next 1 year, more than 1 year, I mean, that's going to be, you're going to shine then, right? I mean, if you're able to do well in this
it's not about
tough
me
period.
It's not about me. Per se, see, for active managers, why do you pay them? See, in good times, anybody can make money. You've seen the aviation. The guys went bankrupt, and now in good times, everybody is trying to become, once the tailwind is there, lower oil price is there, there's too much of growth in the sector, all the players, they have suddenly become, very good. So, why you pay to the managers? 2.5% investor is paying every year on a higher NAV, purely because they have to do well in bad times. In good times, the investor himself can take care of himself. True. So this is exactly the time when you should take care of the. I mean, when do you need the what do you call lifeguards? Not when you're swimming. When you're sinking.
Yeah, absolutely, absolutely. But just describe the corporate sort of profitability cycle as well to us. Yeah, I mean, how challenging is it looking?
It's I mean, we were looking at about last 15-year, 20-year data about the corporate profit aggregates. So there, what we find is that there is a correlation between corporate profits to GDP. That's the one number which is the best way to look at it. Because GDP is rising every year, so 4.5 lakh crores of current profits look very good at one level. But as the GDP, see, when the GDP was 70, 80 lakh crores, then 4 lakh crore profit was 5% of GDP. Now GDP is 140 lakh crores, and still the profit is 4 lakh crores. So clearly it has become almost 3% or just about 3% of the corporate profit. So what happens is, there is a reversion to the mean. So in 2002-03, at the bottom of the cycle, the corporate profit GDP went almost to 2%. And from there, in next 4-5 years, because of global credit boom or whatever, it shot up to 7%. Now you mean three times corporate profit GDP, and GDP itself went double. So doubling of GDP and 3 times of the corporate profit GDP. So it went almost 6 times. Index went from low of 5,000-6,000 to 6,000-7,000. No, it was more like 3,000. From 3,000 it went to 21,000. Exactly it replicated a little more, 7 times in 6 years. And that's the bull run we cannot forget. And that is again going to happen, because what is happening is, from that 7.5% corporate profit GDP, now you have come down to more like 3%. Maybe another 40-50 bips. I don't know where it will bottom out. You know, then next 7-8 years, because there is a reversion. There is some method in
reversion, and there is a cyclicality to it.
Yeah, cyclicality.
But the point also is, are you seeing signs of it? I mean,
yeah, it comes. See, now the first decade of this century was redefined or defined by commodity boom. This decade will be defined by commodity bust.
It's already happened.
It's already happened, but the benefits of it is yet not realized. People are thinking that it might come back. You know, it's like those, what you call earthquake. Once it happens, people are always fearful, second time is going to happen, third time it is going to happen. So like that, people having seen $100, $150 oil, you're always worried, this $48 will go to 60, 100. So you live in the fear for some time.
And your call is that it's over?
No, it's over.
It's over.
It's not going to repeat. This decade is gone for the commodities. And that is going to redefine the entire crop. Who's going to be the winners and losers? Last decade's winners were what? Vedanta, Can India, your Tisco, your Reliance, your all these commodity companies. The guys, I mean, Reliance is not so much of commodity; they are commodity users. But all the crude producing companies, all the iron ore companies, you know,
the miners,
you know, Hindustan Zinc. I mean, they were all in the bankruptcy, and from there they became the highest growth companies and blue chips, bluest of blue chips. You know, and from there everything is falling off. I mean, they have fallen off by 70, 80, 90%. You see the result. The worst is still ahead of the commodities, because everybody is loaded with the leverage, everybody is loaded with the fixed cost, and there is no volume. I mean, first thing is there is a deflation in the price, which is not going to come back, and cost structure is also elevated. So it will. I mean, there is a way to what you call pare the cost, get realigned to the newer cost structure, and so the entire decade will go in that. Then repay the loans.
So who will be the winners per se of this? I mean, we're seeing for the last 2 quarters, we're seeing at a gross margin level the impact showing through strongly. But at a operating level, I mean, it gets diluted quite a bit. In some cases, the difference is quite stark.
Yeah, so fundamentally you have to find companies which are users of these commodities. Of course, every company is using in some way or other. But more particularly the manufacturing companies which use these commodities and have the pricing power on the other side. Say like, say Maruti. Maruti has pricing power in terms of if they're, I mean, aluminum, steel, plastic, when zinc, they go down by say 5% in the entire car. They don't have to pass on that 5% to the consumer. Maybe they will pass, I mean, they'll not increase the price for some time. But suddenly at this point of time, if you're selling the car for 5 lakhs and your cost comes down by 50,000 rupees or say 25,000 rupees, what happens is your margin expands from 10% to 15%.
Okay.
So that boost is there. So you see the Maruti.
So the first, in a way, first criteria, so to speak, is to find, I mean, look at business to consumer companies, right? I mean, franchises instead of companies which sell to other businesses where there is no pricing power.
Yeah, so B2B companies, they were big beneficiaries in the first decade. Now B2C companies will come back big time, and that's why you see the prices of franchises. The companies which are consumer companies somehow, they are, I mean, they're very expensive all over the world because they are the significant beneficiary of this. Packaging materials. I mean, in so many consumer companies, 20-30% of the cost is packaging material. The whole damn thing is fallen by 30-40%. So you see. So
you just use that as an example. It's not completely different, but Jubilant Foodworks, for example, just reported numbers, right? I mean, again, this the stark difference. Gross margins are at a new high. Operating margins are at a new low since the IPO. And this is, I mean,
So that's a different company. I've not seen that thing fully, but they have started new franchise. So what's happening there?
Right.
The
No, I
spend
wanted
is
to
slightly
give you that
slow.
example because it's a very strong franchise.
Yeah.
Right. It's got that brand equity, but at the same time, it's just that competition seems to be and cost seems to be killing them at a operating level.
Yeah, but if you see, more traditional companies, like as I said about automotive, we see all automotive companies, whether it is a Hero, whether it is a Bajaj, whether it is a Maruti, everybody is seeing gross margin expansion, raw material cost reduction, and faster net profit growth than the top line growth. So that's how the landscape is going to be defined. And you see HPPP, IOC coming back to the marketplace. I mean, they were all down and out and almost bankrupt. Today they are looking like a blue chip companies. So I think this change will redefine where exactly money. See, money will be made for sure, I can tell you. Okay. First thing is, let's have faith. Let's be optimist that the mean rate of making money is going to be about 5% of GDP. Okay, that's been the average of last 15, 20 years. So if my GDP is 140 lakh crores in the current year, about 6.5, 7 lakh crores is bound to come, which is about 4.5 lakh crores. Okay, so that will come. Now, I don't know how things will happen, but
who will earn it is the question.
Yeah, it just One is that at aggregate level, this money will be made. Okay. Second, who are the winners? Who are going to be the winners? So then you have to find big trends, and who are going to ride those tailwinds? Where are the tailwinds? Tailwind is not everywhere. Tailwind is not in commodities. Tailwind is not in a whole lot of businesses. Where you are competing with China or you are competing with online. So a lot of retailers, this online deliveries and private equity money, they have busted their entire, not so much the top line, but the bottom line. So you have to be aware of these things, because internet is going to redefine a lot of things. GST is going to redefine a lot of things. So you, as a manager, you have to be very clear where exactly money is going to be made. So please show me the money first.
One sort of area which you talked about is companies which are companies like Maruti essentially, right? Which benefit from falling commodity prices. They can keep some of that. They don't have to pass everything on.
Yeah. So now again, we have to look at the concept of how companies are kind of built. So you have to look at their franchise value and you have to look at the growth value. So where are moats safe? The companies, the businesses which are there, whose moats are safe? Good time, bad time, the companies, they're destined to make money. First thing is find those 30, 40, 50, 100 companies, whatever is there. The new, old ones and of course the new ones emerging. Because without moat, you are not guaranteed of not sinking. Like a float, it's like a float. Moat is like a float. Float will make sure whether you know swimming or not, you will not sink. So you need a moat as a float when you go into the investing. Okay. So first we have to find that. And then after that, growth. Because moat plus growth will give you, hopefully that will give you investment success.
Returns.
Yeah. So finding that is very important. And finding moat is a lot of science. You run your screeners, you can see that. And you can feel it, the good companies, great companies like Lever, Nestle, all these consumer companies are fantastic moat, pharmaceutical companies.
So all this lakhs of crores of money profits that companies are going to make, the obvious question is, which are the companies which are going to make it? Or at least identify those companies which have the tailwinds which will allow them to be able to make these supernormal profits.
Yeah, so I can only talk about the frameworks which we use to, kind of find these companies. And at times we are wrong also. So there will be, we'll buy about say 18, 20 companies in the portfolios, and 4, 5 companies invariably will be off the mark. See, they will be with the moat, so it will not sink. But if you are expecting 25% growth or 20% growth, maybe it might deliver 10% growth or flat or maybe a little lower profit. So those kind of things can happen for sure. But it will not sink. So the portfolio approach allows you to, because you can, in the portfolio approach, what happens is your stock specific risk is limited. You can lose only 1x. I realized much later in the day why the portfolios work. Because you can lose only 1x wherever you put it, whether it is 1 year or 10 years, 20 years. If you have bought 10 rupees worth, you can lose only 10 rupees. Okay. But where you are right, in 10 years, that stock can be 10x, 100x, 1000x. And that asymmetric deal which you get in the stock market because some of the equities will go disproportionately up and some of them will go disproportionately down. So what you have to protect first is what is going to go down. And that's where you need the float. Okay? So once you are with the float, you are bound to, you are arresting the downside. Once you are arrested the downside, the tailwind of the economy, tailwind of the respective businesses, that will just take you to the higher levels.
You know, most conversations like this will focus on the winners, but I think it's also important to just tell our viewers that they can be losers as well. So I would like to ask you to give us one example of what you thought would be 10x, 100x, and then you changed your mind, well, it wasn't to be, and then you quickly acted.
Yeah, so you know, I mean, I've been managing public money only for 2-3 years, you know, in an active fashion. So we have not had much disaster, but one incident I remember in last 2-3 years was that we had bought a company called Financial Technology. We thought that they have a wonderful business model. They've got so many exchanges working, and they had the technology core competency to build exchanges and all. And it was an exponential business model. It was, everybody loved it. And we thought we are on to making some serious money in the next 5-10 years. But we didn't know that, you know, there's a lot of things we didn't know about it. In equity, it happens that you don't know enough things. And then it the whole edifice collapsed. So we had 5% of that. It literally became zero. I mean, we had 80-85% loss, and we just booked it and be done with. In the same year, so I put 5 bucks, and I wanted to double if things worked out. So fortunately, I didn't double, so 5 became like 1. I lost 4 bucks. In the same year, another 5 rupees we had put in Aisha at about 2,000. That went to 8 or 10,000 rupees. So that 5 became 20. This 5 became 0. So in all, I had 10 rupees, which became 20. So despite one complete washout, we were still double between these two companies only. Rest all were normally functioning. So what I'm saying is, you can be wrong and yet you can win if you have a balanced portfolio approach.
How many stocks do you have in your portfolio? What's the optimal number, so to speak?
See, we saw some research. If you are beyond 15, 17 stocks, the diversification benefit. See, this is the benefit of diversification in portfolio. I mean, the 80-90% of the benefit just goes away. I mean, you have captured that benefit. If you are well diversified in the sense that 8-10 businesses, 15-17 stocks of different sizes, different color shape, I think you have got bulk of the diversification benefits. So if you go from 15-17 to whatever makes you comfortable, maybe 30, 40, 50, 60, diversification benefit doesn't give you. But what happens is your span of attention on individual stocks, as the number goes up, starts going down. And you are bringing less and less conviction on individual stocks in the portfolio. Because it's all about the conviction that, see, equity markets are about the future. You're not, I mean, it's not some gold or some jewelry or something like that. You have to, you need the vision to see the future of those businesses which you are buying. Now, how many businesses future you can see? We cannot see our own future. Forget about those 20 companies' future. And so you get some edge in understanding 15-20 companies. But if you are at 80-100, I don't know, I think you need many more guys to take care of the portfolio.
Have 80-100 stocks?
Yeah, most of the diversified portfolios are upwards of 50 companies. 50 is, I think, the norm. Yeah. So, but we have less than 20.
So you don't want to be too concentrated, so it increases the risks too much, but the optimal number.
Yeah, optimal number. And this is our style. It doesn't mean that that's the best style. I mean, if there are 1 million guys in the market, there are 1 million ways of making money. And everybody will justify their style of making money, and they will end up making money. So, I mean, it's a matter of style.
Are there any trends that you're seeing which will lift some boats, so as to speak, in this market right now, apart from the commodity thing that we spoke about?
See, the bigger trends which you have to keep in mind, one is this commodity deflation we talked about. I think this decade will be redefined by commodity deflation, which goes into cost of everything. Even if it is services, it will have some impact. But I think I see internet to be the big thing, in the sense that we have seen in 15 years what internet has done. I mean, more positive aspect of it. And I think internet will redefine a lot of businesses. I mean, pluses also, minuses also. Because the way I see internet, there is a producer of everything, there is a distributor, and there is a consumer. What internet is doing is attacking the middle portion.
Sure.
And exposing the bad producers also, because the middleman, for his own benefit, is covering a lot of bad manufacturers. So since he is going out, it is also exposing the manufacturer. So the good guys will just shine, and he will be in touch with the consumer. So one, it will broaden the distribution, because say my village has 20 guys who can buy stuff, say Nike shoes or some good stuff. Okay, he was not getting that because there is no physical distribution. So now physical distribution will become universal. It will reach everywhere, not in 200 towns or 400 towns. It will reach 5 lakh villages, because you can order one piece and you get it. So that's one positive aspect. Second, I think the non-deserving intimidation, the guys who are not adding value for what they do, I think that portion, even if they survive, that portion of profit will shift to either consumer or to the producer.
But even taking what you're describing, it seems it's more disruption.
Disruptive and deflationary. So your inflation levels will come down with this continuously. Because, I mean, why the CPI and WPI is so much different?
No, profit margin will also come down.
No, profit margin is a very different discussion. Profit margin is, it's a jungle law. Jiski lathi uski bhais. I mean, if I can take 80%, I'll take 80%. If I have that bargaining power, if I have a monopolistic position, duopolistic position, and you are millions of consumers, if I say this thing I'll sell it for not 10 rupees but 15 rupees, you're a mad guy, you want to buy that at 15 rupees, you'll buy. My margin could be my competition would be at 5% and I might be at 20%. So that's a very different discussion. It's between consumer and the producer. I'm just saying the broad trend. So these things have to be mixed up. Where is the bargaining power? So where is the mode?
Consumer staples, for example. Take Lever as an example.
Yeah.
I mean, if Lever is selling soaps or some other product on the internet now, it's still very small in terms of how modern internet as a percentage of the overall distribution thing. But over time, it's possible that when you sell on the internet, the consumer is able to look at all the choices more easily, look at all the prices more easily, and it's different than going to a kirana store.
So internet will redefine in many ways. I mean, the choices. I mean, the existing consumer like you and me who are buying, say, 5 things, will buy 25 things, because the whole global store will be open to you. Okay, your wife should have that time and this thing, and it will become very easy. I mean, they'll make it so easy that it's like a tap, and the whole thing will be. I mean, you want dal, so 1000 variety of dal will be there for you to choose, and you can just. So it will become better and better. Logistic will become better. Ease of doing transaction will be better. Ease of making payments. I mean, the biggest revolution is going to happen in the payment thing itself. So all this thing is going to redefine a lot of companies. It will redefine negatively for the bad companies or bad intermediaries, and it will redefine, because everything is happening for consumer. Consumer is the king. Okay, and it will redefine in a positive way for the guys who are very good, we are small, who are not in the front of the consumer. So if you are a small artist who makes very good, say, a blouse or a trouser or something, you can suddenly see,
But for the incumbents, I'm saying, from the listed incumbents, what does it mean?
Same. I mean, if you have to tighten your belt, and if you become better, you can gain market share. If you are bad, you lose market share overnight.
Immediately.
So that's good. So internet is going to redefine a lot of things. I mean, I cannot tell you everything, but we can see the imprint of internet in a lot of things. Particularly on the services side, financial service side, it will have a huge impact. Huge impact. The traditional banking, I mean, the bankers, they have really kind of used a lot of float or a lot of...
So private banks, for example, does it change things dramatically for them, you think?
So one is that footprint of banking. Fortunately, in India, we have only 40-50% people actually banking. The whole lot of villages and all. So they are all, in next 4-5 years, they'll all be part of the formal banking. So that expands the scope. Now, how do you win there? That, of course, internet will redefine there. So who has got the best technology, who has the best understanding of consumer, and how he is able to connect both of them? So it can in a 15-16% growing banking system. So first thing is the growth rate might go from 15% to 20%, which is huge on this base. Second, if you have 2% share, that goes to 4% or 5%. You know, I mean, so win and lose will be very, very large and very defined. Second, GST. Again, the same impact. Because GST, what it is going to do, again it will attack the intermediary. Because of the law and a large country, a lot of these companies, they have opened shops and shops. I mean, depots and a whole lot of distributor, what is that, F&O agent, and then, so this lot of intermediate cost has been built just to comply with the law. Once it becomes GST, I think the whole logistic will be redefined. It will take some time. I mean, some massive million square foot godowns will come for the companies. They'll put it one center. And now because of internet package deliveries, these centers will become, you know, kind of center of delivery. So combination of internet, GST, and even the cable TV and all these kind of things, your smart shopping, I think these are things which are going to redefine going forward. And we have seen it in other parts of the world.
Okay. Raamdeo, thanks very much for your time. Great speaking with you.
It's always a pleasure.
Happy Diwali to you and to you.
Happy Diwali to you, and very, very good investing experience for the masses who are viewing your this program.
Thanks very much. Thank you.